Disclaimer: stock trading is inherently risky and the users agree to assume complete and full responsibility for the outcomes of all trading decisions that they make, including but not limited to loss of capital. Matthew, chapter 25 verse 14-30, "For it will be like a man going on a journey, who called his servants and entrusted to them his property. To one he gave 5 talents, to another 2, to another 1, to each according to his ability. Then he went away. He who had received the 5 talents went at once and traded with them, and he made 5 talents more. So also he who had the 2 talents made 2 talents more. But he who had received the 1 talent went and dug in the ground and hid his master's money." For today's video, we are going to talk about triple moving average cross strategy. The triple moving average crossover strategy is a popular technical analysis trading strategy that involves using 3 moving averages of different timeframes to identify buy and sell signals. Companies and their stocks produce massive amounts of data, from financial details to historical price patterns. There are hundreds of ways to analyze and compare this data to determine the best time to buy and sell shares. The strategy involves plotting 3 moving averages on a price chart: a short-term moving average, a medium-term moving average, and a long-term moving average. When the short-term moving average crosses above the medium-term moving average and the medium-term moving average crosses above the long-term moving average, it generates a buy signal. When the short-term moving average crosses below the medium-term moving average and the medium-term moving average crosses below the long-term moving average, it generates a sell signal. It's important to note that while the triple moving average crossover strategy can be effective in identifying trend reversals and generating buy and sell signals, it is not foolproof and may not work in all market conditions. Traders should use this strategy in conjunction with other technical and fundamental analysis tools and have a solid risk management plan in place. Choose the timeframes. Choose the 3 moving averages and timeframes that you want to use. For example, you might use the 10-day, 20-day, and 50-day moving averages. Plot the moving averages. Plot the 3 moving averages on a price chart. You can use any charting software or platform that supports moving averages. Identify the signals. Look for the points where the short-term moving average crosses above the medium-term moving average and the medium-term moving average crosses above the long-term moving average. These are buy signals. Look for the points where the short-term moving average crosses below the medium-term moving average and the medium-term moving average crosses below the long-term moving average. These are sell signals. Enter and exit trades. When a buy signal is generated, consider entering a long position in the stock or security. When a sell signal is generated, consider exiting the long position or entering a short position. It's important to have a solid risk management plan in place and to use stop-loss orders to limit potential losses. Monitor the signals. Continue to monitor the signals and adjust your trading strategy as needed. Consider using other technical and fundamental analysis tools to confirm the signals and identify potential trade opportunities. It's important to note that the triple moving average cross strategy is not foolproof and may not work in all market conditions. It's important to use this strategy in conjunction with other analysis tools and have a solid risk management plan in place. Additionally, this strategy is just one of many trading strategies, and it's important to choose the strategy that aligns with your goals and preferences.
That's all. Thank you for watching. I hope you learned many new things about the stock market. Kindly subscribe to our channel and click the notification bell. Also follow us on our Facebook page to learn more about the stock market.